Yeah. I just finished laminating. I don't have it with me here, but I put for my oldest son, who's viewer for the viewer that doesn't know, who's 17 years old, since he's about probably 10, maybe 11, I laminate, and you know this, I laminate motivational or perspective providing quotes and put them in his shower. So he's just forced to see them. And I just finished replacing some of them. So when he comes home next week, he'll have a fresh new set of quotes to look at.
Feel like this is going to lead to some therapy later down the line.
I could, or it could be, I figure my downside is low and my upside is more than that.
So, what is the chance that this becomes like an intergenerational thing where he's just like, you know what? When I have kids, I'm going to do that what my dad did to me.
That'd be great. I think that'd be awesome. I love that.
Yeah, of
He
course you
uses
would.
them against me every now and then.
He puts up pictures of like the middle finger in your shower and says, "This is what I think of your charts."
No, Brett, you'll
Quotes.
use one of the quotes to provide some perspective to me when I'm saying something. He doesn't always use them properly. And admittedly, sometimes he uses them to try to further his unfounded point or desire, but he still uses them. Every now and then he hits them properly.
Why wouldn't Schaefer love the charts on the shower, the quotes in the shower too?
It's funny. I tried. She goes, nope.
Heard plus hugged plus helped equals
I
love.
should try again. I'll throw that one on there. Do you want to be heard, helped, or hugged?
We
You
have
should
three.
know. You shouldn't have to ask, damn it.
Oh, what? Yeah, you've been married for what? 10 years? No, 5 years?
I know we have been married 6 years.
Six. Oh, so close.
Yeah, you're close. You're 11 years.
We are going to be 14 in 1 week. And you know what the symbol of 14 is?
1-4.
No, not the number, not how to write 114. The
Okay.
symbol. Every year has a symbol associated with it, right?
A rectangle.
There's a tradition. No, not that kind of symbol. Like a wood or ceramic or glass or
Oh, yeah,
something.
that's the traditional wedding gift. I did steel this year.
You did steel. Okay, I'm up to gold slash ivory. Ivory is a bit
Oh my
challenging to
God, you
get
killed an elephant.
because no, exactly. No, there are a lot of fake ivory things, but no, I did not go with ivory. I went with the gold.
No, you said you were getting an elephant tusk.
No, you said I was getting elephant tusk. I said I'm getting gold.
Yeah, no, you made the right choice. I figured you were gonna go the elephant route, and then you said, you know what, economic value favors gold.
Oh
So
yeah, yeah, yeah.
yeah, I get it. I know how your brain works, buddy. We've been doing this for a while. Welcome to episode 47 of Talk Your Chart. I am Marco Segrera, along with my partner, Brett Horowitz. Brett, you ready?
Start us off. Let's go.
Brett, I want to start with a quick story about housing. Specifically, a blog dude, a guy in his mid 30s, real estate investor, personal finance writer, about 5 million followers on YouTube. Check him out if you like that type of stuff. He put together a little newsletter that was actually shared with me by our colleague Flavio, basically pointing to the fact that we all know this, but I thought this was an interesting example. Media likes to put out headlines that make you upset, make you angry, and give you someone to point the finger at and blame for whatever issue you're dealing with right now. And the one this guy, given his competency as real estate, the one he brought to the table is a lot of these media outlets blaming Wall Street or these large private equity firms for buying up all these houses, and that being the reason why we can't afford anything.
Better than blaming the president, because I thought that's where you're gonna go with this.
Yeah, which is another person that everyone likes to blame at all times. So I put up this chart just to kind of work in tandem with the idea here, which this chart is showing you is the percentage increase of those four stats since 2012. Obviously, you can see the purple line, which is the average price of a home, has gone way up, and the other ones have gone way down. And by way down, I really just mean look at new housing sales. It fell off a cliff in 22 because of rates. We basically know why housing is unaffordable now. It's not because of Wall Street. The quick stat I'll give you, only 1.6% of all single family rental homes in America are owned by private equity. The remaining 98% are owned by everyday people like you and me. Boom, done. Sealed, delivered. Why are prices high? Mortgage rates are the highest they've been since 2000. Inventory is the lowest it's been since 99. And because of artificially low rates, over 60% of homeowners have rates locked in, 30-year money under 4%.
Yeah, I mean, I don't know. We talked in the past. There's so many reasons why, beyond just those two reasons, that they're not building enough homes. That more people are looking to move, and it's a problem. I'm not sure how it gets fixed. I like the stat that you gave, that suggests that most people it's an individual person doing it, but you still have a lot of foreign investors out there. You still got a lot of cash buyers. You still got a lot of people who can afford to do that, and so that doesn't help as well. The prices we've seen are just outrageous. I don't know what changes that. I don't know what gets us to the point where it becomes more affordable, because that was the American dream, right? Everybody always said, you want to buy it, you want to get a mortgage, then you can deduct that mortgage. Like, this is not the case anymore.
Yeah, and so I think that helps to bring up another point, which is the whole buy versus rent thing. Um, I think like most personal planning, that decision has to be made very personal, depending on your circumstances. If you're going to live somewhere for 5 years versus 10 years, that's going to obviously impact your decision here. The second chart I brought up, which Graham also brings in his blog post, is just the cost to buy versus the cost to rent. And obviously, in looking at this chart, mathematically, it doesn't make any sense right now to even consider buying, unless, as Graham puts it, you're going to be owning this thing for over 10 years, which is perhaps reasonable. Again, that's not something that's rule of thumb. That's just what he's putting together. I'm going to read out his example because I think he articulates it well. If you were to buy $1 million home, you'd have to put $200,000 down, take on a mortgage of $5,600, in addition to $100,000 in property taxes, insurance, and maintenance. So $6,600 a month. Or you could rent that same house for $3,900.
Yeah, so if you were a policymaker and you said, we want more people to buy houses, we want people, because that's sort of like a forced savings, right? You put your money into a house, you don't touch it for 30 years, you pay down your mortgage, you got equity. It's some way to at least force yourself to save. If you were trying to get more people to buy, how do you reverse the situation? What do you do?
Rates will come down and prices will come down, or a combination of those two things are going to happen. I don't know how, I don't know when, but that's what's going to happen. If you're going to try to incentivize home buying now, tax credits is the only thing that ever makes sense. The other piece they don't control, which is interest rates.
Well, you showed the chart, what, last episode or the one before, about how interest rate adjustable rate mortgages are in other countries. Like, that's not even the case here. So like, if this is unaffordable here, imagine if this was, Australia or somewhere else where 90% are adjustable.
Yeah, that's going to be a problem. Yeah, what's funny is now you're seeing, for obvious reasons, a lot more home purchases with adjustable rate mortgages, right? Now is when it would make sense to use that strategy in a home purchase.
I mean, I wonder what the statistic is for number of percent of people that are foreign buyers. Like, is there a way that you could prevent that or tighten that up a little bit, like they have in China, where you can only buy one property, or like, sometimes two properties? Like, I don't really want
You know
government to
what?
get involved, but
I don't I think the markets have to handle that. Here's what I tell you. I think we have a little bit of availability bias as people that live in Miami, because I think folks across the nation are probably not experiencing that much pressure on home values from foreign buyers like we are. That's Miami's a different piece. Probably just coastal areas. You get your New York's, California's. I don't even think Texas is much of an international destination.
oh yeah, I think I don't. It was a few episodes ago we talked about how many places in the U.S. are not like Miami. How many places are still have property prices that are lower than they were in 2007, before the real estate bust happened, right? Like, so there are still some good deals out there. We know of a colleague that moved to Texas and he got a $300,000 house, in a nice neighborhood, and it had a lot of square footage, and like, forget about paying four times that in Miami to find something.
Yeah,
So it is
good,
regional.
good for him, not Miami. Yeah.
Yeah. Okay, you want to hit on your next chart? We're turning to the tax.
No, that was my two. I saved my third one for last.
Okay, so we're going to talk about taxes, everyone's favorite or not favorite word. I know you love paying taxes, Marco, so I do not.
We just lost half the viewers.
But look, for some reason, our clients I think we all are okay with paying our fair share of taxes, but when you bring up taxes with clients, they absolutely shake with fear and they get, in some cases, angry that there are taxes being generated off the portfolio. Even though I offer for every client, if you've got a gain, I'll take the gain and I'll pay the tax. It never works. But for some reason, clients hate paying taxes. And so I'm going to talk about what we're using these last 2 months to do in client portfolios to help alleviate taxes.
Nice.
We always tell clients we'd rather have big gains and big taxes than have losses, but there's at least some things to do in certain situations that I want to go through that we spend a lot of time doing in the last few months of the year that I don't think clients appreciate.
Okay.
So this is for the viewer that's either not doing it or knows somebody doesn't work with somebody that hasn't taken advantage of this. The first chart is talking about intentionally taking losses on portfolios, on
This
investment.
is the chart with the blue investment A and the purple
Right.
investment B.
Yeah.
All right.
So here's it. So someone has investment A. It's had a gain of $20,000. It's sitting there because it was sold earlier in the year. You got investment B that's got a big loss, 25,000. And so for us, we don't like losses, but you try to make lemonades out of lemon. And so in this case, you're taking that loss to offset the gain, basically wiping out their tax, providing them a little bit of tax benefit because you can take $3,000 of unused losses every year and continue to roll that forward each and every year going forward. So this year, not much that we could do, but in a year like 2020, when markets were down, you better believe we sold anything we could find for a loss and immediately bought it back 30 days later so that we get the eventual appreciation.
I'm in. So this is the fancy word for all this is tax loss harvesting.
Yeah, it's something that we look at for every client in every position in every taxable account every year.
Yeah.
In a year like this where everything's up, it's probably hard to find losses. But if you own something that is down, you better believe we'll look to take the loss and offset other gains.
Yeah. And this is a public service announcement to all clients out there, whether forget clients, to all people out there, whether you work with us or anyone else. When you sell something for a capital gain, it's in your interest to let your advisors know that that has happened. So not just at the end of a year, but when it's happening or when it's going to happen, because you can start tax planning for that before it's done. And that's a sale for a gain or a sale for a loss.
Well, that's a great segue, Marco. Speaking of planning ahead, one of the things that we also spent a lot of time doing in the last month of the year is something about avoiding capital gain distributions. Lots of mutual funds, when they trade throughout the year, they spit off income and capital gains. At the end of the year, then that produces a capital gain distribution. So all these funds, and here's an example of some DFA funds that we own, will tell you in advance what the capital gain distribution will look like and when it is being paid. What do we do? We go in every client's account, every taxable client's account who holds this fund, and we look to see what is that client's gain. Is it higher or lower than the gain paying out? So for example, the first two funds here are paying out a 3 to 4% distribution. That's taxable to our clients. If someone owns that fund and they have a 1% unrealized gain, they've been in it since the beginning and they've only made 1%, or they're down and they've never made any money, you'd rather sell it ahead of the gain and avoid that distribution and then get back in immediately thereafter. If you've got a 4% gain or higher in the fund, might as well take this gain as opposed to selling and taking a bigger gain. So that's important and something we do for all of our clients automatically every year.
Yeah. Let me add one thing in this chart. It already has it on it. Maybe you do this intentionally. Brett, I'm asking you a question, which I know you love, but this one's easy, I promise. What are the capital gains distributions being paid out by the ETFs that are at the bottom of this chart?
When are they being paid out?
No, how much? What are they?
Oh, probably zero.
It's quite literally zero. It shows it on here. That's wonderful. That is a wonderful feature of the ETF structure. And it's why we're moving a lot of our portfolio over to that structure versus holding mutual funds. Mutual funds can be wonderful as chassis, as vehicles, and some strategies require that structure, but many don't. And to the extent they don't, you're not going to see it in our portfolios.
Right. Yeah. I think ETFs can pay out capital gain distributions, but it's far less likely.
Yeah, yes, they're not functionally required to, because the way they're redeemed doesn't impact all other holders.
So this is something we do for every client without you having to tell us about it. But lots of clients have mutual funds outside of us, where I would say, you as the viewer, if you own something, take a look, plan in ahead. You don't want to just be sitting there taking the distribution every year if you don't have to. There may be an opportunity out there. The
Okay, well,
last thing I'm going to touch on real briefly is lots of clients are either above 65 Medicare age and they pay Medicare premiums based on their income, or they're below 65 and belong to the Obamacare ACA exchange and they pay premiums based on their income. And there's different threshold that they want to stay below. God forbid you put me into a higher bracket because my portfolio made too much money. God forbid I pay more Medicare premiums or more ACA premiums. However, there are a subset of clients who are retired in their 60s, where you can see here on the left in 2022, they had very low income. And so this is an example of a client where we think on that sort of fourth line, IRA distributions, we might be able to do what's called a Roth conversion, kind of complicated, but just basically moving money from an IRA to a Roth, paying income now at a low tax bracket, and then avoiding that income later on when they could be in a higher tax bracket.
okay.
So the first chart shows them that we're going to add about 70,000 of IRA distributions to their income and hope that that gets us to a sweet spot. Whereas the second chart shows us, the analysis that our tax planning software gives us to show us where is our marginal rate, where is our capital gains rate, and where is our Medicare rate to make sure that we're not screwing something up intentionally.
Okay. So you're in the second chart, there's a nice aqua rectangle around the 12% marginal bracket. And what the range next to the 12%, 22,089, that's where the 12% bracket applies. And then this is saying that this particular person is up to 66,000. So the room is in the 12 bracket is from 66 to 89.
Mm-hmm. Yeah, this is putting them, if they did the Roth conversion, that would be their income, 66, and they'd have a little bit of wiggle room still left in case
Exactly.
income's a little higher. So you
Excellent.
and I both do this for people all the time, but it's a fantastic method when someone has some low income years to be able to take advantage of that situation where they're not paying a lot of taxes and hope to get out money at a very low rate and avoid a high rate then in the future.
Okay, I like it.
So looking for opportunities, right? You're looking for ways to take advantage of someone who's low taxes or someone's got losses and find ways to avoid paying higher taxes.
Yeah, it's smoothing out the tax bill. Let me ask you this though. What about the person who says, wait. I get it. I can pay a 12% tax now, but I'd rather defer the tax as long as I can to keep earning that tax deferred growth.
Yeah, like if you're always going to be in the 12% bracket, then you don't want to pay tax now versus pay later. But if in 5 years you're going to be in the 25% tax bracket, I tell you, you can save some money by paying it now than paying it later. It all
Okay.
depends on the difference, the delta in tax brackets and how long you'll be in a low tax bracket versus a high one.
Okay. And how upset you get when you pay more taxes to the government.
Yeah, right. Like that's the big thing. If you've got a job that's going to pay you $100,000 for consulting, or you've got a portfolio that makes, a couple $100,000 and that's capital gains, and we take those, like that's a good position to be in because even though your taxes will go up, the amount you've made is a lot more than the taxes you paid.
Yeah.
You don't want
Yeah,
to be
that's
too
all. The Roth conversions can be beautiful. The problem with anything planning related is the future by definition is unknowable. So it's tough when too many variables come into play.
Exactly.
Yeah. Keep
You
it
do your
simple.
best though with the information you have, and you go with something that makes sense, and hopefully it works out.
Do you do your best? Do you always do your best, Brent?
That is a scout's honor, I think. Do your best. No, let's be prepared.
Nice, dude. That's right. You know how to tie those knots with ropes because you did that.
Right.
That's awesome. Good for you, man. All right. My chart. All right, good. This one's a little wonky to look at, but let's keep it real simple. Left chart. Actually, rewind. Why did I bring this chart up? Because bonds. Because Brett, are bonds more attractive now than they were a year ago to invest in?
Yes.
I agree with you. This has led a fair amount of folks, and this is not even people that we talk to that we work with. This is some people like on the street who say, why would I invest in stocks? Because bonds are the best now, especially right now. Look at CDs, look at right now, look at right now. We get it. Bonds are more attractive today than they were yesterday, really more a year ago. But you have to look at it on a relative basis. So why would you not want to completely avoid stocks is because just because bonds have gotten better on a relative basis doesn't mean that stocks suddenly stink. So what we're going to do in the left chart is compare the S&P 500 earnings yield with the 10-year treasury yield. And there's a little rule of thumb in the world of stocks and bonds that says when the S&P 500 earnings yield, which is like the dividend yield on it, take the PE ratio and flip it on its head. So take the earnings divided by the price. When that gets low, 0 and below, mathematically, there's a little bit of a, well, it's better to invest in bonds than it is stocks. That blue line that wiggles a ton on the left side, that's the difference of the two. You can clearly see from about 2001 to now, it's been positive. And there's that real big period when rates were, call them artificially low, that there was a massive difference. How often did you say Tina in those days, Brett?
That was all we were talking about.
Exactly. There is no alternative.
Now
We
there
get it.
is.
Now there is.
Now there is.
But let's look at when the spread is where it is right now. The spread is just the difference of the two. What do returns look like on the equity side? So if we look at where we are right now, which is like a 0 to 1% difference, and we jump to the right side of this chart, the x-axis here is showing us when we're in that range of 0 to 1%. So when the S&P earnings yield is about 0 to 1% higher than the Treasury, what return are you getting over the next 12 months? Again, I wish it would have gone longer periods of time, to be honest with you, but I only found it with 12 months. You're getting a 12.8% average return. You can use that same exercise across all the different ranges or spreads. As you can see, most of the time it's positive. Where do you kind of start dropping into the negative piece? Well, yeah, when the earning yield is negative.
Yeah, well, I'm surprised it's not like up and to the right. Like
Me
I'm
too.
surprised.
Me too, to be honest. Yeah, me too.
Because that's what you'd expect. The higher the S&P yield relative to Treasury, the more attractive stocks are to bonds. But to your point, I think it's obvious that when the S&P yield is negative or less than the bond yield, you go with bonds because that's why that's the case there. But it's a strong point to stocks all forever, right? I mean, stocks should make more than bonds over a 12-month period in most cases.
Yeah, that's it. So you don't abandon bonds. This doesn't mean you need stocks. Maybe you just can't stomach it, right? And you'll never be able to own them ever. I just doubt it. And what you shouldn't do right now is abandon them, because
All right,
abandoning things is not a good thing unless it's something bad for your health.
we've come off of the last time we had a big drop in the market was last year in the stock market. Before that was 2020. Before that was 2018. Like it happens every once in a while, but we're now looking at about 5% off the all-time high in the stock market. As long as you own a diversified portfolio, that'll come back. We will hit new highs again in the near future.
I wish I could disagree with you, but I can't. Next time I'm going to disagree with you.
Facts.
That's all I got.
Same here.
Let's get out of here before this fire drill turns out to be real.
Well, I'm not leaving. This is too important.
Later.
Bye.